Hello everyone, my name is Elliot Gu. I'm co-founder of Smart Bonds, and today I want to talk a little bit about the Fed meeting that's coming up later on this week on Wednesday, October 29th, why I think it's important, and what I think is more important than the fact that they're likely to cut interest rates. Just last week on Friday, in my Smart Bond service, in the 3 model portfolios that I include in the paid tier of that service, we made some pretty dramatic adjustments to the portfolio. We've been making some gradual shifts over the last, since the inception of the portfolio in May of 2024. But we did take a little bit stronger step last Friday, and this is a major issue that I don't think is getting enough attention in the mainstream media. So first up, let me just start out with this slide. The Fed is heavily expected to cut rates this week by 25 basis points. Fed fund futures show a 98.3% probability they cut on Wednesday, October 29th by 25 basis points. Market also sees a 91.1% probability the Fed cuts twice this year in the last 2 meetings this year, October 29th and December 10th. That would be a total of 50 basis points. Now, the current Fed funds target range is 4% to 4.25%, or 400 basis points to 425 basis points. So if they do cut 50 basis points this year, that would take us down to a 350 to 375 basis point federal funds target range. Now, what about next year? Now, on this slide, I'm actually showing you the 2 meetings from next year. The April 29th meeting, April 29th, 2026, that will be Fed Chair Jerome Powell's last term as chair. His term ends on May 15th of 2026. And so by the June meeting, the scheduled June meeting next year, President Donald Trump is expected to appoint a new leader of the Fed who's almost certainly going to be more dovish, more inclined to want to cut interest rates or ease monetary policy than Jerome Powell. The president himself has said that, of course, but also, Treasury Secretary Scott Bessent has also said that, U.S. interest rates are too high. They're far into restrictive territory right now. So whether or not we get interest rate cuts in the first part of next year, which I think we will, the market's currently pricing in pretty strong odds that interest rates will be cut once or twice in the first 2 meetings or in the first part of next year through that April 29th meeting. But they're looking for even stronger likelihood of cuts by the end of next year. Now, by the end of next year, the final Fed meeting in 2026, December 9th, 2026, they are expected to cut. There's about a 60% probability in Fed funds futures, a little over 60%, that Fed funds rate will end next year below 3%. The leading bet right now is 2.75 to 3% range. The next leading is 250 to 275, as you can see on this slide. There are some people looking for 300 to 325, about a 25% probability there. But as you can see, the majority believe interest rates are going to end next year below 3%. Now, the current rate, as I said, is 4 to 4.25%. So that's pretty significant easing. Now, this is something I wrote about at great length in a post I put up on the Smart Bonds website at the end of last week. I'll link to it below. I don't want to talk about that today. I want to talk about something I didn't talk about last week, which I think is arguably even more important. And it's something you really need to watch this Wednesday when the Fed announces what it plans to do. And that has to do with quantitative easing. And quantitative tightening, rather. So most of you are aware of what quantitative easing and quantitative tightening are. Under quantitative easing, the Fed is actually buying bonds, treasury bonds, mortgage-backed securities in the past, and they're increasing the size of their balance sheet. In quantitative tightening regimes, they're allowing the bonds they have in their portfolio to roll out of their portfolio. Now, what do I mean by that? Well, when you buy a bond, you get periodic interest payments on that bond, and then, of course, you get a principal repayment when the bond matures. And so what the Fed has been doing is they're not reinvesting those principal and interest payments in new bonds. So once the bond matures, they take the principal repayment and they don't buy another bond to replace it. Under a stable state, where the Fed is targeting a stable balance sheet as opposed to growing under quantitative easing or declining under QT, they would reinvest those proceeds into mortgage-backed securities and treasury bonds. Effectively, though, the Fed has said they want to get away from owning mortgage bonds over time, and they want to focus their portfolio more on treasury bonds. And so what they've been doing is any principal or interest repayments in mortgage-backed securities above their monthly cap, they've been putting those in treasury bonds, and they may very well continue to do that. The big picture, as you can see on this chart, is back in, I believe it was March of 2022, was the peak for the Fed's balance sheet, around $8.5 trillion. Today, right now, it's in the low sixes range, around 6.2 or 6.3 trillion. And the way quantitative easing works is that the Fed establishes caps for the amount of bonds that they're going to allow to mature and roll off their balance sheet every single month, right? So instead of saying, we're going to reduce our balance sheet by 100 billion, what they say is every month we're going to reduce our holdings of treasury securities by no more than X billion, and our portfolio of mortgage-backed securities by no more than Y billion. So effectively that means that any principal or interest received from bonds in a given month that's over that cap, they would reinvest into new debt, but anything under that, they would simply allow it to mature and roll off their balance sheet. Now, I'm going to throw up a slide real quick here. This is actually kind of the timeline of quantitative tightening. The initial phase, June to August 2022, just a couple months there. The cap was $30 billion a month for treasuries, $17.5 for MBS, a total of $47.5 billion a month rolling off their balance sheet. The full pace from September 2022 through May 2024, so almost 2 years, $60 billion a month in treasuries, $35 billion in mortgage-backed securities, total of $95 billion a month. The first time they tapered QT was in June of 2024, June of last year. Then they reduced their cap on treasury to $25 billion a month rolling off their balance sheet. They maintained their MBS cap, mortgage-backed security cap, at $35 billion. So the total amount was $60 billion. The second taper was April 1st of this year, 2025. They reduced treasuries down to $5 billion, maintained that MBS cap at $35 billion, so the total rate of quantitative tightening is $40 billion a month. Now, you'll notice that they've already eliminated most of their treasury bill quantitative tightening or treasury bond quantitative tightening. They have maintained, though, that MBS tightening at $35 billion a month. What I'm expecting them to do this week is to actually either end QT outright or announce a plan to end it over the next few months. But I expect QT to be history by the end of this year, perhaps very early next year, but more likely this year. And what that means is that they would start reinvesting all the principal and interest repayments they get from their treasury bond portfolio. So those assets would stop declining, and their holdings of treasury bonds would kind of go flat. I also expect them to either reduce or probably eliminate that $35 billion monthly cap on mortgage-backed securities rolling off their balance sheet. So what I suspect they may try to do is, instead of reinvesting those principal and interest repayments from MBS into new MBS, they may reinvest all or a portion of it in treasuries instead. So you could actually see their holdings of treasury bonds start to go up again. Now, why is this important? Well, think about it in terms of the government borrowing money in the bond market. Up until 2022, as you can see here, the Fed was doing a lot of quantitative easing. So they were buying bonds, treasury bonds, and mortgage-backed securities, driving up the price of those bonds and down the yields on those bonds. Also, when the Treasury wanted to go out and sell more bonds to borrow more money, right, to raise more money to fund pretty substantial deficits for all of this time, right, they could easily go out and sell those bonds because the Fed was a major buyer of bonds that they were selling. So that kept downward pressure on their borrowing costs. Under quantitative tightening, the bonds that were rolling off the Fed's balance sheet every month, right, up to $95 billion a month, these had to be replaced by new debt. When the Treasury went out to borrow more money to fund the deficit, right, they were forced to sell that to the private sector. So the private market was forced to absorb more of this Treasury issuance because the Fed wasn't buying Treasury bonds anymore. Of course, that puts upward pressure on yields on longer-term Treasury bonds, also on mortgage-backed security yields, because there's a major buyer of those bonds previously is now a net seller of those bonds. As the Fed gets to a point where it's keeping its assets on its balance sheet steady, at least there's no marginal sort of net seller of bonds in the market every month because the Treasury or the Federal Reserve is continuing to reinvest those proceeds. So the Treasury has to find new buyers, of course, for new debt, but on net, there's one less significant seller in the Treasury bond market. That would tend to put downward pressure on yields. And that is actually a major reason why I think that the experience in longer-term Treasury markets going forward into 2026 is going to be a lot different than it was a year ago when the Fed started cutting rates. Back a year ago, there was a lot of speculation over the summer of 2024 the Fed would cut. Treasury bonds rallied, the 10-year yield dropped, right? But once the Fed started cutting, the market started to look forward. It's always a forward-looking mechanism to 2025, and they said, probably the pace of cutting is going to slow or stop, and the Fed is still doing quantitative tightening. So the bond market actually sold off into early 2025. This year, we're seeing a different pattern. The Fed has started cutting. Treasury yields have been rallying, but that rally is stuck a lot more than it did after their first rate cut back in September 2024. More importantly, I think the market is focused on additional rate cuts to come in 2026, as well as the end of quantitative tightening, which also has a major impact. So I think we could see a significant rally in the overall bond market next year. Now, you might ask, why is the Fed easing so much? Why are they easing so much when the economy actually looks to be in a pretty good state? Why would they actually want to end quantitative tightening when the economy is looking pretty solid right now? Well, the answer to that is a little bit more esoteric. So I'm going to try to go over this quickly, break it down for you quickly. But generally speaking, the Fed, what they care about more than inflation, honestly, what they care about more than the health of the labor market, and those are their two mandates, is the health of the financial system, right? In the sense that particularly short-term credit markets, when they start to break, that really can have major impacts on the economy more broadly. So you can see a situation like back in the financial crisis years where the credit markets in the United States ground to a halt. You saw short-term interest rates really spike, for example, in the interbank loan market, which I'll talk about here in a minute. And that actually caused more long-term economic damage and intermediate-term economic damage than almost anything else that happened in that era. And so what can happen when the credit markets are broken, a mild slowdown and sort of a soft landing scenario can quickly morph into something much more dangerous. So the Fed is very sensitive to instability in credit markets. Now, back in 2019, we saw an instability in the repo market. It was called repo madness at the time. This is a short-term lending market. Again, I'm going to break it down for you in more detail here in a second. But the Fed actually started buying T-bills, Treasury bills, short-term U.S. government bonds back in the fall of 2019, even though they had been up to that point quantitative tightening. Now, the Fed told you then, they'll still tell you today that that was not QE because it wasn't quite the same as normal QE. But, not QE looked an awful lot like QE in 2019 because the size of the Fed's balance sheet was rising. They were actively buying short-term Treasury bills to calm this repo market. Now, since that time, they actually set up a number of facilities to sort of prevent a breakdown in that short-term bond market. Let me throw up this slide. Gives you some of these basic terms. Now, anyone who spent any time reading anything out of the federal government knows that the government loves acronyms. They love complicated sounding names and facilities and programs that get abbreviated to acronyms. And I'm just going to throw this slide up. You can go through it on your own time, but let me hit some of these main facilities that you need to be aware of that you're going to hear a lot more talk about over the next few weeks, I think. First up, the Secured Overnight Financing Rate, SOFR it's called. Now this is a market, a commercial market for short-term overnight loans. And the Federal Reserve Bank of New York actually publishes data on transactions in this market, and there are a lot. every single day, what the average rate was, what some of the rates paid in this loan market were on that particular day. This is the benchmark that actually replaced LIBOR, the London Interbank Offered Rate. So what it is let's say a bank or a money market fund want to borrow or lend money. So typically a money market fund might lend money and a bank might be the borrower. So it's very short-term loan, as I said, one day, overnight. So what can happen is the bank could go to this market and they could borrow money, they could borrow cash from the money market fund, right, at the SOFR rate, which is an annualized rate. And the bank would pledge collateral in the form of treasury bonds or mortgage-backed securities, which are backed up by the agencies like Fannie Mae, Freddie Mac, or Ginnie Mae. So they pledge this collateral. It's a collateralized market, and they borrow the money overnight, and then it all gets reversed the next day, right? So it's a way for a financial institution with excess cash, whether it be a money market fund or any bank, for example, to borrow or lend money overnight. If they have excess cash, they can earn a return on that cash. So this rate, the SOFR rate, does tend to be heavily influenced by Fed policy, right? Now the Fed targets officially what's known as the Fed funds rate, right at the bottom of my slide. Now the Fed funds rate is an unsecured rate available to banks only that have, commercial banks that have money on deposit as reserves at the Federal Reserve, held as reserves at the Federal Reserve. And this is a rate at which they can borrow or lend that money to other banks, other financial institutions on an overnight basis, but it's unsecured in this case because these are reserves actually held at the Federal Reserve itself. Now this is the interest rate that the Fed targets. Now the Fed, as you might have noticed, doesn't say, the Fed funds rate is 4.15%. They give you a range, right? The lower bound of that range is right now 4%. The upper bound of that range right now is 4.25%. I believe this Wednesday, that's going to be, 3.75 to 4%. And by the end of this year, I think it's going to be 3.5 to 3.75%. Now, how do they actually maintain these short-term interest rate benchmarks, the effective Fed funds rate, but more importantly, that SOFR rate, kind of in that Fed funds range? Well, that's where these other acronyms come in. You have the IORB, which is the interest on reserve balances. Now, this is an interest rate that a bank can earn by keeping money as reserves at the federal bank, at the central bank, at the Federal Reserve. So it's always set at 10 basis points, or it has always been set at 10 basis points under the upper end of the Fed funds target range. For example, right now, the Fed funds target range, 4 to 4.25%. The IORB rate is 4.15%. So this is the annualized interest rate that banks can earn for having money on deposit or as reserves at the Federal Reserve banks. And this, again, is on an overnight basis, but that's the annualized rate. The other acronym you need to be aware of is the overnight reverse repurchase agreement rate, which is known as the ONRRP. Now, this is a rate that other financial institutions that aren't commercial banks, that don't have reserves at the Fed, can earn by parking money overnight at the Fed. Now, the most common user of this facility would be money market funds. So a money market fund can go to the Fed, they can put money at the Fed overnight in this facility and earn an interest rate, a return on that money. This is an annualized rate set at the low end of the Fed funds target range, the ONRRP. For example, right now, a money market fund could go to the Fed and earn a 4% annualized return by putting money on at the Fed, parking money at the Fed overnight in this ONRRP facility. Now, the SRF facility, this is called the Standing Repo Facility. This is set at the upper end of the Fed's target range, in this case 4.25%. So what this is let's say that the short-term lending rates in the commercial bank market, that's the SOFR market, where banks and other financial institutions can borrow and lend from each other overnight on a collateralized basis. Let's assume that those rates were to rise a lot. So let's say that right now, with the upper end of the Fed funds target range at 4.25%, the SOFR rate was coming in at 4.35%, so 10 basis points above. Well, as an alternative to borrowing at 4.35%, a bank or a commercial bank, for example, could go to the Fed and borrow money overnight from the Fed that they need at that 4.25% rate, at the upper end of the Fed funds band. So obviously this acts as sort of a ceiling on the SOFR rate, right? The short-term lending rate. So you have the ONRRP as the floor, because if SOFR were below the low end of the Fed funds target range, then you would assume that most money market mutual funds or money market funds or commercial banks that had excess money to lend, rather than lending at the lower SOFR rate, they would go and park that money at the Fed for that guaranteed ONRRP rate. The SRF acts as the high end of the range, because if a bank can't borrow money on the commercial market because SOFR is too high, they can go borrow that money from the Fed via this SRF facility that was set up actually in 2021 in response to that 2019 repo madness incident that I just outlined. Here's what all that looks like in practice. The light blue line on this chart is the SOFR rate. And I took this back to early 2024 simply for illustrative purposes. That darker blue line you see, that's the ONRRP rate. That orange line you see, that would be the IORB rate. And that green line you see would be the upper end of the Fed's target range for this entire time period. So what you can see is that generally speaking, the SOFR rate sits below the IORB rate, right? But above the low end of the Fed funds target range. So typically in a healthy market, in a normal credit market, if you will, that blue line, that SOFR rate, will be in the lower half of the Fed funds target range. Now, you will see instances on this chart where it spikes to the high end of the range or even above the range. Oftentimes that happens at the end of a quarter. At the end of every quarter, banks are usually short of reserves. They're actively borrowing reserves in that overnight market. So you see a short-term spike in demand and a short-term spike in the rates paid in that SOFR market. That's nothing particularly unusual. But I invite you to look at the far right end of my chart, and this is the period since the September rate cut this year, where the Fed cut 25 basis points in September 2025. And what you can see is that since that time, right, the SOFR rate has been sitting in the upper half of the Fed's target range. And in fact, we've seen several spikes above the high end of that range, where SOFR rates have actually been above the high end of the Fed's target range. This is quite unusual, and it's a sign of increased stress in these short-term lending markets, in this repo market. In fact, it's such a concern that Fed Chair Jerome Powell mentioned it in a speech he did last week or the week before, here in October anyway, in Pennsylvania, where he talked about some signs of stress in the repo market, in the short-term lending market. And you can see in particular, this hasn't just happened as a consequence of the end of the quarter games, right? We did see a spike at the end of September. Really wasn't all that unusual, not even much more than what we saw back in the end of June, actually less than. But we've seen it since then as well, including particularly on October 15th, October 16th of this month. What that suggests is there's not enough money in the system. There are not enough reserves in the system for banks to borrow or lend from each other at the Fed, at that IORB rate. And there's not enough cash in the system to meet demand for short-term overnight loans. So it's a sign of stress in these markets. Now let me show you an even more concerning chart. Now this chart is actually a chart of utilization of that SRF facility, that ceiling facility where banks can borrow money from the Fed overnight at the top end of the Fed's effective range. And typically, the daily limit in this market is $500 billion. That's a lot, right? But typically you see zero. Typically, as I showed you, the SRF, the SOFR number rate was below the midpoint, really, of the Fed funds target range in the lower half or lower 2/3 or so of that range. So, no bank is going to borrow at the high end of the Fed funds range when they can do so at the low end of the Fed funds range or the lower half of the range. But lately you do see spikes at the quarter end, as I mentioned, of the use of this facility. But lately we've seen the biggest utilization of this facility in years outside those quarter end periods. And so that's what this chart shows. You can see that for most of this period, there was zero outstanding use of this facility. Right at the end of June, you saw a spike. You saw another little spike right at the end of September. But this month, you've actually seen some even bigger spikes than we saw at the end of last quarter, at the end of Q3, and the end of September, just in the middle of the month, which is highly unusual. This is also a sign of stress. What it means is that that commercial lending market, securitized or collateralized lending market, the rates are climbing above where they would normally be expected to be. And so banks are choosing to borrow from the Fed at that high end of the Fed funds target range rather than pay up and borrow on the SOFR market. That's a sign of monetary tightness, and it's something brand new. Now, let me show you this next chart is actually a chart of total bank reserves held at the central bank. These are reserves held by commercial banks at the central bank, earning that IORB rate, right? Now, reserves are extremely important because they underpin the entire credit system. When a bank goes out and lends money in the market, a lot of that's backed by these reserves that they hold at the Fed. Now, nobody knows exactly what's a comfortable level of reserves at the Fed, but we do think that 3 trillion is a key number. I've heard some numbers a little lower than that, maybe 2.7 trillion. But the fact is that when the Fed is quantitative tightening, when they're allowing bonds to roll off their balance sheet, what that generally means, as I said, is that the private market has to fund more of the federal government's deficit, right? They have to buy the bonds to offset the fact that the Fed is no longer buying bonds. And what that does is it tends to put downward pressure held on reserves. So, right, when an individual wants to buy a treasury bond, when you or I want to buy an actual treasury bond, or we buy a mutual fund that goes out and buys a treasury bond, we might write a check from our checking account to pay for that. And so that money would come out of, ultimately, those bank reserves held at the Fed. So under quantitative tightening, you tend to see money drain from the banking system. And that's exactly what we've seen here. Now, this is a chart of reserves going back to 2020. You can see the big soaring in reserves up through 2022 during quantitative easing. A big pullback in reserves during the initial stages of quantitative tightening, but reserves have been kind of trading sideways since late 2022, early 2023. We saw a dip on some of the quarter ends. As I mentioned, that's a time when reserves come into premium. But we've seen the most significant dip in reserves to below $3 trillion now, right, as of last Wednesday. This actually is the average over last week, but that's also under $3 trillion. We've seen the most significant drop in bank reserves outside of those quarter end or month end type gains. And this is a concern. What it suggests, especially coupled with that prior chart of SOFR and all those facilities I talked about, it suggests tightness in credit markets. The easiest way to alleviate that, of course, is to end quantitative tightening. It does take some pressure off the short-term credit markets, right? Because it means that the Fed will be holding its balance sheet constant, so there won't be that supply of new debt that needs to be absorbed by the market every single month. In addition, if the Fed were to stop allowing MBS to roll off its balance sheet, or more likely allow principal and interest repayments from mortgage-backed securities to be reinvested in treasuries, we could actually see the Fed start buying treasuries, right, as those principal interest repayments roll in from MBS to hold its overall balance sheet constant. This will tend to increase or at least slow the descent of reserve balances at the Fed as they end QT. And that's why I think they're going to do it. The Fed is attuned to nothing more than what's going on in these short-term credit markets. Obviously their dual mandate involves inflation and also the labor market and unemployment rate, but they really do spend a lot of time, pay a lot of attention to this short-term lending market It's even more important in influencing actions in many cases than month-to-month shifts in the unemployment rate, or a 0.1 or 0.2% uptick or downtick in inflation, even though it gets a ton less attention in the mainstream media. One more thing I want to talk about very quickly, because I know this video is already running a little long, is what's going on in that MBS market. And this chart actually shows the yield on a 10-year Treasury bond versus the yield on the 30-year fixed rate mortgage in the US on average every year since 1995. And one thing that's been garnering a lot of attention lately is there's an unusually large spread here. In other words, historically, on average, 30-year mortgage bond rates have been somewhere between 1.6 and 1.8% above the yield on the 10-year Treasury bond. Right now, it's more like 2.2%. One reason for that is the selling that we're getting from the Fed in QT, or the effect of allowing those MBS securities to roll off their balance sheet. Another factor, of course, is that mortgage activity has been very low due to the lack of real estate transactions due to high interest rates. So there's actually a proposal out there making the rounds that has seen some interest from the federal government. And the idea is to let Fannie Mae and/or Freddie Mac actually purchase MBS on the open market to drive down this rate spread. Now, this could actually be effectively done without additional action from Congress. Fannie Mae and Freddie Mac, under federal government conservatorship, already have the capacity to increase the size of their balance sheets a bit from the current level, and not just a bit, well over $200 billion. And so the proposal would be to use that excess availability on their balance sheets to purchase MBS and try to push the spread on mortgage bonds lower relative to the 10-year yield. This is something the Treasury Secretary, obviously President Trump, and many others have talked about being a big problem and a reason why rates need to come down. I don't think you're going to see, as some community lenders have proposed, Fannie Mae and Freddie Mac go out and buy, $200 billion worth of MBS in the next 6 months or a year. But you could very well see a proposal for 50 or 100 billion in MBS purchases at some point next year. And that could actually have a real effect, because transaction volumes in the MBS market have been relatively low for the reasons I just outlined. So don't be surprised to see MBS, mortgage-backed securities, rally as well. We actually added some exposure to that market in last week's issue of Smart Bonds. So I know this is a little esoteric, but I think it's very important to understand what's going on. Don't just to pay attention to whether the Fed cuts or doesn't cut interest rates, or even what they say about Fed rate cuts in December or early next year. What you need to understand is what's going on this short-term repo market. That's the real story. You can monitor all these things yourselves, but it's something I do cover in the Smart Bond service, both in the free version as well as in the paid version. With the paid version, with the paid tier of Smart Bonds, you do actually get access to my 3 model portfolios. We have a baseline model portfolio, which only includes bond, credit, and preferred stock ETFs, exchange traded funds, easy to buy and sell here in the United States. We have a defensive portfolio that does the same thing, but is designed to have lower average volatility. And then we have a dynamic 60-40 portfolio, which owns a combination of stock ETFs, mainly the S&P 500 stock ETF, and bonds, right? Bond ETFs. And it's designed to be an alternative to the traditional mix of just holding 60% stocks and 40% bonds. We actually vary those percentages based on market conditions, some systems that we follow, as well as some discretionary indicators, that I've followed for very many years about the market and economy. If you'd like to check out exactly what we're recommending in Smart Bonds, we are offering 30-day absolutely free trials to the service for the next week. This actually expires on Sunday, this coming Sunday, in early November, this offer. But we are offering 30-day free trials to Smart Bonds. You can claim that by clicking the link below this video. Now, what that means is that we will not charge your credit card for the first 30 days that you have Smart Bonds. If you decide it's not for you for any reason whatsoever, Simply cancel your subscription and you'll never be billed for the service. If you decide to continue with the service past that 30-day free trial period, you would be billed at either our monthly rate, which is $30 a month, or our annual rate, which is $300 a year. So I hope you found this useful, and I hope that you'll be watching this on Wednesday's Fed meeting. If you're interested in finding out more about our high yield portfolios in the Smart Bond service, why don't you give a free trial of the paid service by clicking the link below. Thanks again for listening, and I hope you found this useful.